Hello everyone, welcome to our Egyptian online seminar group. First, confirms of then if you have any questions, you can ask our speaker during his presentation or after his presentation. I have great pleasure of welcoming dear Professor Chan Daniel Zhang. Chan is an assistant professor of accounting at the School of Accounting and Finance, University of Waterloo. He received a PhD in business from Penn State. He conducts archival and analytical financial and accounting research to examine how accounting information facilitates different user decision making. His research has been published into ranking journals, including Journal of Accounting and Economics and Contemporary Accounting Research. Now we will start our seminar with dear Professor Chan Jiang.
Thank you, Mohamed. Thank you for your kind words. Hello, everyone. This is Daniel from University of Waterloo. Thank you for Mohamed's invitation. It is really my pleasure today to present one of my latest work on disaggregation and anomalies. And this is a brand new paper. My co-authors and I managed to finish the first draft only in the last month. So we look forward to today's audience the feedback, because all comments and suggestions we can get today are surely very important for our paper's future development. And like I said, this is a co-authored work with Steve Haddad and Kai Du, both are from Penn State. I think Steve is in the audience. Do you want to say hi?
Sure, happy to say hi. I guess a special call out to Jeremiah Green, who used to be at Penn State too. Long time no see, Jeremiah.
Thank you, Steve. Okay, so the general research question we want to explore in this paper is whether the disaggregation of the accounting information on the 10K filings affects the magnitude of the accounting-based stock return anomalies. So please bear with me a couple of minutes before I explain what our definition of information disaggregation is and how we are going to measure it in our study. So in the literature, many accounting-based anomalies arise because investors either underreact or overreact to accounting information in the first place, and then the price correction will take some time to happen. In other words, if investors could better understand the pricing implication of those accounting numbers in the first place, then a lot of accounting-based anomalies would be weakened or even disappear. Now the question is, how firms' public disclosure can facilitate investors' information processing. In our study, we propose that by providing more granular information on the 10K filing may help in this process. So ideally, we want to examine all accounting-based anomalies to ensure our findings are generalized enough. Apparently, the task is too ambitious and very time-consuming. So for our first draft, we focused on the operating profitability anomaly. Given the fact that this OP anomaly has been one of the most robust anomalies and that it has not been arbitraged away in the recent years, so we are very happy to use it as the test bed in our first draft. So just a couple of more words about this OP anomaly. It was first documented by Ribot and his co-authors in their 2015 JFE study. So the basic idea is that relative to other profitability measures, such as the gross margin and bottom line earnings, operating profitability is the cleaner measure of the firm's economic profitability because it better matches firm's current revenue with the current expenses. But if investors still underreact to the operating profitability and their initial underreaction only gets corrected as they learn more about firm's future probability, then the firm's future stock returns will be increasing in the operating profitability. So in other words, the OP has a positive stock return predictive power. So empirically speaking, to calculate operating profitability, we subtract both the cost of the sales and the operating expenses from the revenue. And all these line items can be very easy to be extracted from the income statement. However, firm can actually exercise their discretion to provide more granular information by breaking down those line items into their respective components. For example, so this is part of the income statement from the Apple's 10K filings. So Apple break down both its revenue and the cost of sales into a product component and a service component. And Apple also reports two types of operating expenses. One is R&D expenses, the other one is SG&A expenses. But if we look at the income statement from the T-Mobile 10K filings, first we notice that the T-Mobile combined the cost of the sales and operating expenses into one section, but it's fine. But more importantly, from the T-Mobile's income statement, there are in total 8 revenue-related line items, 2 cost of sales-related line items, and 5 operating expenses related line items. So even if we just compare the income statement from Apple with the income statement from the T-Mobile, we can still see that the granularity of the information vary a lot across different firms, and that the concept of information disaggregation in our study is intended to capture the granularity of the information. So the more specific research question we want to study in our current draft is whether information disaggregation, in particular about operating profitability, affects the magnitude of the operating profitability anomaly. We believe there are some tensions here. So on the one hand, if more granular information improves the investors' information processing and allows them to better anticipate firms' future profitability, then investors would not underreact to the operating profitability in the first place. Therefore, if that is the case, we should observe an attenuation of the OP anomaly when there is a more disaggregated disclosure. But on the other hand, if investors only care about getting the value of operating profitability regardless of its component, or if more granular disclosures actually impose more information processing cost on investors, then the information disaggregation either does not affect the magnitude of the OP anomaly or even amplify its magnitude. So before I get into our research design details, here is the preview of our main findings. So first and foremost, we do find the evidence showing that information disaggregation can attenuate the magnitude of the OP anomaly. Secondly, we find not all disaggregation is created equal because the location of the disaggregation matters. So after we measure the disaggregation separately for the operating profitability related information recognized on the face of the income statement and those disclosed in the note, we find that only the information disaggregation on the face of the income statement can consistently attenuate the OP anomaly, and we cannot draw the same conclusion with the information disaggregation happening in the note. And then we try to explore the mechanism underlying the information disaggregation attenuation effect. So since the OP anomaly starts with the investors underreaction, so we would expect to observe a weaker anomaly if investors can react stronger in the first place. And this is what we find in our analysis. We find that investors react more strongly to the operating profitability signal around the 10K filing date when there is more granular information about operating profitability on the face of the income statement. So given this OP anomaly, sophisticated investors would sure love to arbitrage it by trading on the OP signal, and the investors' arbitraging activity can be attributed to a lot of the disappearance of the accounting-based anomalies. I think Jeremiah, he has the paper study of that phenomenon. However, we think that the arbitrage efficiency will depend on their counterparties, the uninformed investors in the trading process. In particular, it depends on how long the uninformed investors will learn about the operating profitability's pricing implication. Since the uninformed investors mainly rely on the firm's public disclosure, the disclosure quality therefore plays a role in the price correction process. So prior studies such as Boucher et al. 2019 accounting review find that the poor financial reporting quality actually reduces the arbitrage efficiency and it delays the price correction. So if the information disaggregation actually reflects a good financial reporting quality, then it could also explain why it attenuates the magnitude of the operating profitability anomaly. And we do find some supporting evidence in our analysis. Specifically, we find that firms disclosing more granular information about operating profitability are less likely to engage in classification shifting, and they are less likely to issue material restatement about their operating profitability disclosure in the future. So in terms of the contribution, I think our study speaks to the recent standard status push for more disaggregated income statement information. There are two concurrent studies also looking into this issue. So Hinson et al. 2024, this is a brand new accounting review publication. They studied the revenue disaggregation and they find that more disaggregated revenue disclosure improves the analyst sales forecast accuracy and reduce their forecast dispersion. And similarly, there's a brand new working paper, Bland and Moon 2023. In their studies, they find that, okay, I see Jeremiah leave a comments in the chat. Let me finish my contribution part, and then I will go back to your questions. So, so the Bland and Moon find that the cost of goods sold-based disaggregation improves the investors and analyst processing of the expense-related news. I think our studies make the contribution because we combine the anomaly literature with the studies on the disaggregation of accounting information. And as I will explain later, the disaggregation measure we proposed in our study has more flexibility, and it can be easily extended or customized to evaluate the disaggregation of this disclosure on other accounting topics. Finally, like I mentioned in our preview of the main findings, we find not all disaggregation is created equal because the disaggregation on the face of the financial statement and the disaggregation in the disclosure note will affect investors differently. Okay, let me get to Jeremiah's question. A second.
Yeah, Daniel, my question is really just about the portrayal of operating profitability as an anomaly. I mean, I'm kind of on that side of things, but I think the pushback you might get are the papers that say that operating profitability is not an anomaly, right? But it's the returns are compensation for risk. And especially the Ball paper, I think the most convincing part of that is that they show that operating profitability predicts returns for long windows.
Yeah, for 10 years,
and
right?
So, yeah, so then to me, that part, thinking that investors don't understand the disaggregation piece for up to 10 years is the part that's a little bit not clear to me. So do you have, is that something you can address through that, or do you just have to sort of kind of step aside of it, I guess is my question.
Well, you know what, we intentionally try to avoid the debate whether this is a mispricing story or this is a risked story. I think it is still up to debate, because like if, as later I will show the result, say when there are like more granular informations, actually there's no abnormal returns associated with the trading on the operating profitability. So if it is the risk story, then in my mind, it doesn't matter how granular your disclosure is, you can always earn some abnormal returns because of the existence of the risk, because of the risk. So I don't think it is the debate about whether it is a mispricing or risk is settled. But I acknowledge one limitation about our study, as I will discuss later, because we rely on the XBRL data to construct our disaggregation measure, which restrict our sample period to the most recent 10 years so that we cannot do a long-term test. But we will definitely keep that in mind. I think that this should be one of the questions first to jump into a lot of the readers' mind, whether this is a risk story or mispricing story. But thank you, Jeremiah.
So I think you said, just to clarify, so I think you said that you're saying we don't know if it's risk or mispricing, and your evidence supports the mispricing story, right? That's your claim. I think the pushback that you can get from, I'm on the mispricing side, but I think that someone else could say, well, in 10 years, someone for sure can, even with high sort of cost of figuring it out, they're going to figure it out before 10 years. It doesn't take that long. So to me, that's a conceptual issue of if you show this, can you help explain why it would take? Okay. Are you explaining just a very small little piece, right? That seems to put some weight on the mispricing side, but you can't explain why in other cases it still lasts 10 years, or are you going to be able to come up with some explanation why it could last for 10 years? I think it's just like, I would buy what you're saying. It's just a matter of, do all the pieces fit together, or are you just sort of, you just have to ignore that other piece, I guess, is my question.
No, I don't think we can ignore it like in the later process, but like for now, my thinking is, of course, I need to discuss with Steve and Kai later. For now, my thinking is, I think in the original like Raybould studies, their sample period is 40 or 50 years long. So I mean, at least I can just cut it into like the sub period to see whether this 10-year forecasting, like the 10-year predictability exists in every sub period. And also, I think like some new information technology, the rise of the new information technology may play a role. I think David Hirschleifer and his co-author recently has a very latest paper and examining the impact of those new information technology, including the Edgar and XBRL, how it affects the mispricing of a lot of like accounting-based anomalies. So to take both into the consideration, I would, my naive guess is the 10-year like predictive power mainly exists in the early period, because it is really hard for the investors to grab a complete picture about, say, the disclosures on the operating profitability. And then in the most recent years, as we have more new information technology, I don't think, I highly doubted whether we still have that 10-year predictive power. But I think that should be a fairly straightforward test to check, to cut like 40 years or 50 years into like 10-year sub period to see whether we always have that long run like predictive power.
Yeah, thanks. Yeah, I agree with that.
Yeah, thank you, Jeremiah. Okay, contribution. Yeah, I think we have already talked about the contribution. Okay, now let's move to talk about the research design. So speaking of the research design, I think our main challenge is to come up with the information disaggregation measure. And so if we look at the Apple's income statement example again, intuitively, we can just count the number of the line items or the numerical facts that we can use to calculate the operating profitability. For example, on the Apple's 10K filings, there are in total 11 line items on the income statement that are relevant to the operating profitability, and we can do, depending on which line items we can use, we can always calculate the operating income by ourselves. But again, if we switch to the T-Mobile's income statement, and we just count the number of line items before the line items operating income, there are in total 16 operating profitability related line item. So the idea is quite intuitive. If we can simply count the number of the line item or the number of numerical facts related to the operating profitability, but we basically face two challenges. One, to our knowledge, there are no data vendors providing the raw 10K data in a structured way. Two, among all numerical facts that firms disclose on the 10K filings, how do we determine which accounting numbers are relevant to the operating profitability and which numbers are not? So as I just respond to Jeremiah, to overcome these two challenges, we turn to the XBRL data. So since 2012, all public firms in the US have been required to file their 10K filings in the XBRL format. Specifically, filers need to select an XBRL tag for every number they report on the 10K filings. For example, again, this is the income statement from Apple, and the tag for the line items, for example, the total cost of sales, the tag is cost of goods and service sold, and the tag for gross margin is gross profit. So tagging the numbers on the 10K filings not only makes them more machine readable, more importantly, there is a well-defined hierarchical structure called the reporting taxonomy that defines the calculation relationship among all the XBRL tags. So this is a snapshot about the reporting taxonomy. As we can see, the taxonomy can be visualized as a tree structure. And we think this is a very powerful tool because it not only allows us to identify the tags that are relevant to the calculation of operating profitability, but it also allows us to assign the level of depth to each tag. So what is the level of depth? So let me just explain it a little bit before we proceed. So the tag at the very top level on the reporting taxonomy usually represent the high-level accounting concept. For example, the accounting concept that interests in our study is operating profitability, and the corresponding tag is operating income loss. So we will consider this tag, the operating income loss, have the level of depth being 1 because it is at the highest level of the reporting taxonomy, at least this part of the reporting taxonomy. Then according to the taxonomy, operating income loss has 3 child tags, namely gross profit, operating expenses, and other operating income expenses net, all of which are at level 2. 2 is their level of depth because they are 1 level below their parent tag. So using these 3 child tags, we can easily calculate the operating income loss. And then for each of those 2 level 2 tags, we can find its own child tags using the taxonomy as well, and their child tags will be at level 3. So of course, we can keep expanding this tree structure to find all of the child tags to say the level 3 tags, etc., etc. So in general, tags with a lower level of depth, for example, tags at level 1, they will represent a high-level accounting concept. In our case, that is the operating profitability. And the tags with higher level of depth, that's level 2 or level 3 tags, they will represent more granular accounting concept. So using this reporting taxonomy, we can easily identify all of the descendants to the tag operating income loss. Descendants means the child tag, the grandchild tag, or the great-grandchild tags. And all of those tags that are descendant to the operating income loss, they are relevant or they are related to the calculation of operating profitability. So as a result, using the XBRL data, we can measure the information disaggregation in our studies in 2 ways. One, we can simply count the number of operating profitability related tags on the 10K filings. And 2, the second measure or the proxy we use is the average level of depth among all OP related tags. Since we rely on the XBRL data to construct this information disaggregation proxies, So our sample period has been restricted to be between 2012 and 2022. I think this is kind of one of the limitations to our studies. And our XBL data, another beautiful parts about XBL data is they are totally free. We can directly download it from the SEC website. So other than this SEC compiled XBL formatted 10K data, the other data sources are fairly common in the financial accounting research. Basically, we use the accounting data, some other accounting data from CompuStat and stock return data from CRISP. Okay, so this is the one of the table I want to show Jeremiah before. So we use this table to show whether the information disaggregation affects the magnitude of the OP anomaly. So to examine that, we perform both the portfolio analysis and the Fama-Macbeth cross-sectional regressions. So in the portfolio analysis, at the end of June, we first sort firms into terciles based on the information disaggregation from the most recent 10K filings. Then within each disaggregation tercile, we further sort stock into the quintiles based on the operating profitability. And we follow the standard drill to calculate the value-weighted abnormal returns for those sequentially sorted portfolios. And the magnitude of the OP anomaly is measured by the abnormal returns to the hatched portfolio, which takes the long positions in the top OP quintile and the short positions in the bottom OP quintile. And as shown in the slides, when we proxy the information disaggregation, we simply count the number of OP-related tags. The magnitude of the OP anomaly monotonically decreases with the number of tags. And for the tercile of the observations with the most OP-related tags, actually, the OP anomaly actually just disappears. And if we switch our information disaggregation proxy from the number of the tags to the average level of depth among those OP-related tags, basically we find the similar findings for the firms that use the most disaggregated, that disclose the most disaggregated operating profitability information on their 10K filings. We did not document the significant OP anomalies. So in the next, we want to examine whether the location of the information disaggregation matters. So firms not only can exercise the discretion to provide the granular information on the 10K filings, it is also up to them to choose where to provide that granular information. So this is another example. This is part of the income statement from the American Vanguard 2021 10K filings. As we can see, the filer did not provide many details about their operating profitabilities on the face of the income statement. So all line items are all referred to a pretty high-level accounting concept on the face of the income statement. But instead,
Daniel, can I ask another question?
Sure.
I mean, I put that in the chat that I think you probably do have this, but do you describe what makes disaggregators and not disaggregators different? Like some descriptively sort of what they look like?
No, we don't have that type. You think like maybe some like determination test? So which type of the firms?
Yeah, I think the other major sort of concern people are going to have is disaggregators are just different from the non-disaggregators. And so providing some sort of description of what they look like and which types of firms. I guess the example was helpful, but I think giving a little more about that would help, right? Because I think in all of these anomalies, there's always the issue of, but it's just something else that you're not capturing. So it would be nice to just see, you know, that it's along some lines that I might expect, or it's, you know, it's different than I expect. I think that would be helpful.
Okay. Yeah, thank you. This is something we can definitely see. We can definitely put on our long to-do list. So, okay. So for this, again, just continue our examples for this American Vanguard actually provide more details or more granular information, in particular about operating expenses in the note to the income statement instead of providing it on the face of the income statement. So prior studies have shown that investors usually view the accounting numbers differently, depends on where the investors can see those numbers. In particular, investors find that the accounting numbers disclosed in the note having lower reliabilities, and the investors would face higher information processing costs for numbers disclosed in the note relative to the numbers recognized on the face of the financial statement. So following this argument, so if the information disaggregation could attenuate the OP anomaly, then we would expect the attenuation effect to concentrate on the information disaggregation happening on the face of the income statement. So to examine whether the location matters, basically we differentiate the OP-related tags used on the face of the financial statement from those that are included in the note. And we also calculate the average level of depths among the tags in those two locations. And then we repeat our portfolio analysis and the Feynman-Macbeth regression analysis. So in this way, I want to show you some results from the Feynman-Macbeth cross-sectional regression. So in the regression, if information disaggregation attenuates the OP anomaly, then we would expect to observe a negative coefficient to the interaction term between the operating profitability and the decile ranking of the information disaggregation. As we show in the slides, we can only observe the negative coefficient when we measure the information disaggregation using the tags on the face of the income statement. So this one is the number of tags on the face of the income statement, and this items refers to the average level of depth among those tags.
Sorry, one more, Daniel. Like,
sure.
Sorry, I don't have to be the only person asking stuff, but so the tags, they have to tag. This is just my stupidity about this. They have to tag notes also, not just face of the financial statements?
Yeah, they have, according to the US GAAP, you have to tag everything. It doesn't matter where the number is. Under the IFRS regulation, basically firms are only required to tag the numbers on the face of the financial statement, and it is up to them whether they want to tag the numbers in the note. So
you just blew my mind. Like I didn't know that. Oh, that's cool.
Yeah, so I think this is why we feel like this XBL data is very unique to this settings. And if we again to get back to the result, if we look at the tag used in the note, we don't find any significant result, which suggests that only the information disaggregation on the face of the income statement consistently attenuates the OP anomaly. So in the next set of analysis, we try to study the mechanism underlying the information disaggregation's attenuation effects. So given that the OP anomaly starts with the investors and reaction, as I mentioned at the start, naturally, if investors could react stronger to the OP signal when there is more granular information on the 10K filings, then there will be less mispricing to be corrected later, and it would be also consistent with the information disaggregation's attenuation effect. And this is indeed what we find when we examine the investors' reactions to the 10K filings. So in the analysis, we regress the cumulative abnormal returns around 10K filing date on the OP signal as well, and also the interactions between the OP and the decile ranking of the information disaggregation. And we find a significantly positive coefficient when we measure the information disaggregation with the number of OP-related tag on the face of the income statement. And if we switch our proxies to the average level of depth among those tags on the face of the income statement, the coefficient is only marginally significant. And also, interestingly, we find a significantly negative coefficient for the interaction terms between OP and the average level of depth among texts in the note, which in our opinion, this negative coefficient suggests that the granular information in the note actually could impose higher processing costs on the investors, and it may jeopardize the investors' understanding about the pricing implication from this operating profitability signal. And
Daniel, sorry, I have a question real quick. It's kind of related to this on the face of the income statement versus in the notes. It's Don Monk. I'm from the University of Florida. Thanks for presenting the paper. Just had a question on if the tags for the notes are a superset of those that are on the face of the income statement. So then those summary line items are effectively broken down in the notes. So like you see here, so total operating expenses would be on the face of the income statement. So are you not counting that as tagged in the notes, although it's shown here in the notes? Or so I guess, do you understand?
Yeah. We took an incremental approach. Only the tags like uniquely shown up in the note will be considered as the note tag. If the tag shown both on the face of the income statement and the note, we will still consider it as a statement tag.
Okay, so it's the incremental ones that are tagged, and they're only okay.
Yeah.
Okay. Thank you. Thank you.
Sure. Thank you, Don, for the question. Oops. Okay, yeah, this is part we said. Okay, so finally, we want to examine whether information disaggregation speaks about financial reporting quality. So prior studies find that a poor financial reporting quality delays the price correction process because uninformed investors need a longer time to revise their expectations about the firm's fundamental value. So following this argument, so if 10K filing are of high quality, when filer disclose more granular information on it, then investors could quickly arbitrage away any mispricing from the initial misreactions, which could also explain why information disaggregation attenuates the magnitude of the anomaly. So in the empirical analysis, we try to evaluate the 10K filings financial reporting quality with two proxies. The first one is the likelihood of engaging in the classification shifting. So other than the commonly known accrual management and real earnings management, classification shifting is the third way to manipulate earnings. And this type of earnings manipulation, in our opinion, is more relevant to the OP anomaly because by misclassifying operating expenses as non-operating expenses, firms manipulate their operating profitability up, which suggests that their reported operating profitability has a low quality. So in our empirical analysis, we regress the abnormal operating profitability on the income decreasing special items. So the positive coefficient on the income decreasing special items suggests that the firm could paint a rosy picture about their operating profitability by pushing things down to the non-operating section. But more importantly, we observed a negative coefficient on the interaction terms, which suggests that firms that report granular information about the operating profitability on the 10K filings are less likely to engage in the classification shifting, so that their reported operating profitability should have a better quality. And the last table I want to show is we also find that firms are reporting more granular information on their 10K filings are less likely to issue the material restatement about their operating profitability in the future. Once again, it suggests that the information disaggregation reflects a better reporting quality. Yeah, this is the last table I want to show. I think, again, this is a very preliminary study. So that is why I only have like just a couple of tables to show everyone here. But we think although it is a preliminary study, I think our study is still very important. First, I think we propose a new XBRL-based information disaggregation measure. And as I mentioned, it is relatively easy to use because the XBRL data is free to access, and it has a lot of flexibility, and it can be easily customized to other settings. And in terms of our findings, our analysis shows that the information disaggregation, especially those disaggregation on the face of the income statement, attenuates the operating profitability anomaly, and the investors will react stronger to the OP signal if there are more granular disclosures on the 10K filings. And we also show that 10K filings with more granular disclosure are usually having a better reporting quality. So with that being said, I'm going to open the floor again to answer if there's any questions I haven't addressed during the presentation.
Thank
So
you very
Daniel,
much.
can I ask another one? Sorry,
Sure.
Sorry, Mohamed.
Yeah.
Oh yeah, maybe I should raise my hand like that.
No.
So to apply this to another, let's say, set of anomalies, would you need the measure to be a summary? So operating profitability, you have operating income as the sort of anchor that you can count from, right?
Yeah.
So anything else that you have, would you need that anchor to do the counting, or would you,
well,
how would you apply it? So I'm trying to figure out if this is applicable to a broad set of things and you could create the measure for a broad set of things, or if it can only be sort of these summary items that you can use.
Well, I think it is in my mind, I think it's applicable to everything, because it doesn't matter what you want to study. You have an accounting concept in mind, right? And you can always find an XBRL tag referring to that accounting concept. And then you just go to the reporting taxonomy, and then you can find the relevant structures that is relevant to the accounting concept in my mind. I can let me see whether I can show you something. Okay. There is a website just for the XBRL, the taxonomy. And it depends on where that accounting concept is. For example, in my case, it is shown up in the statement of income or income statement, and you can just keep expanding this tree structure. Okay, I need to go to the calculation part. And yeah, you just keep expanding on this tree structure until you reach to the tag associated with the accounting concept that you are interested in. And then you can basically find the tree structure specifically to that concept. For me, I just keep you see, now I find the operating income loss. So everything that is below this concept that is relevant to my study about operating income loss. But just in the case, like if you are really interested in a very, very detailed accounting concept, then that concept may not have any descendants afterwards. But I feel like for the majority of the accounting research we are doing, it always refers to a pretty high level accounting concept. If that is the case, we can always apply this approach.
The one follow-up, I'm sorry to jump you holding hands on that. I think it would be really powerful if you could find another one that could be used as comparison to where you have, let's say, operating profitability has a really long depth, but the comparison one does not, right? So right now it seems like it could be just generally applicable to just having more stuff in your income statement, or more tags or whatever, versus in a particular area you're disaggregating. I think that if you could somehow make that comparison, I think that would make it more powerful, I guess.
Yeah, speaking to this question, we do, again, our first draft, we can only finish our analysis, the full set of analysis for the OP anomaly. We do try to extend our findings to other anomalies or mispricing, for example, the R&D expenses, as you remember. So whether it is easy for you to locate the R&D tag on the income statement actually matters to the mispricing of the R&D expenses. If it is very easy for the investor to locate the standard R&D tag on the income statement, then the mispricing is less severe than the other case where the R&D tag is either not reported on the face of the income statement, or the filer use a custom tag for the R&D expenses. So I think that may sort of address to your comments, because R&D itself is a more detailed or more disaggregated accounting concept relative to the operating income loss.
Yeah, and if you could show they're not the same companies that are disaggregating in both things, I think that would help. Yeah.
Okay. Thank you, Jeremiah. Yeah.
Can you have a question?
Yep.
Hello.
Hello.
Greetings from Kuwait.
Hi.
My name is Gökberk, and we are using 10Ks for the valuation purposes in our capstone course. And one primary issue that we face in majority of the American companies is their classification of the revenues from the geographies are limited. For example, if you look at Apple revenue segments from the countries or the geographies, you will find that they are reporting EMEA, Europe, Middle East, and Africa. So at once, we are talking about 3 different continents with major differences in the countries. So what I have observed during my 1 year or more of this teaching, observing these 10Ks, I think the primary concern that I have is the revenues. I don't know if it is available in the tags. For example, did you ever decide to put a classification, a subsample that companies that make a better geographic explanations and limited geographic explanations or limited geographic disclosures?
Yeah, I think this is a very good question. We do have these discussions among our co-author teams, because for now, if you look at the disaggregation we talk about in our study, we consider this is a vertical disaggregation. So every line item is all about the consolidated entity. But in your case, I think you are talking about the segment reporting, or we describe it as like the horizontal disaggregation. So we only focus on the revenue, but the revenue from the different parts of the company. We haven't done any analysis regarding that type of a disaggregation, but that would be something interesting that we can do in the additional analysis to see the different type of the disaggregation, how it will affect investors that processing the information. But I think the XBR data can definitely help us to identify those, say, the segment reporting type disaggregation. Yes. Does that answer your question?
Thank you so much.
No problem.
Jane?
I guess it's my turn now. Hi, Daniel. Thank you for your presentation. My name is Jaja Fu. I'm from University of Texas, Rio Grande Valley. Throughout the presentation, although you didn't specifically mention disclosure quality, but I'm keeping thinking of the disclosure quality. And I remember there's a paper by Chen Miao and Terry Sheffling, right? They have a draft paper created the measure of disclosure quality based on the disaggregation. So I want to ask, like, broadly speaking, do you think the paper is essentially capturing the disclosure quality effect? Like when you have better disclosure quality, we see the diminished or the attenuated market mispricing.
Well, I think that paper is very famous. We definitely know that. I think the main issue with that paper is the way they measure the disaggregation is using the CompuStat data.
Yes.
And like we the three co-authors on this paper, we do have a JE paper, like trying to compare like the data, the XBR data with the CompuStat data, and in that paper, we managed to show actually, because the CompuStat needs to do a lot of the standardization and aggregation before providing data to the users. And in this disaggregation, the aggregation and the standardization process, the computer science may distort some original data from the 10K filings. So we don't think that measure is perfectly captures the information disaggregation we try to do in this paper. Another difference between our paper and the Chen Miao and Shavlin's paper is that I think their disaggregation is about, say, the overall 10K filings or just about overall income statement or overall balance sheet. But our disaggregation measure is the more like accounting concept specific. For example, we are only interested in the operating profitability, so we can measure the granularity of disclosure just about the operating profitability instead of relying on a noisy measure saying that the granularity of the income statement, because we don't need everything from the income statement. We only need the information about operating profitability on the income statement. And another point I want to point out is actually in our JE study, we try to replicate Chen Miao and Shavlin's the findings using the XBL data. Unfortunately, we are only able to replicate some of their findings. So, which means if we switch the data source from the CompuStat to the XBRL, some of their findings may just disappear. But again, I have to point to the limitation of using XBRL data is we have a fairly short the sample period, not like their original study. So we are not really compared apple with apple. So
I see. Thank you. Thank you for this explanation. It really helped me to understand the fundamental of this measure. Related questions that because the paper makes me think because you're using XBRL data, tag data, and that makes me think of another paper, which was accounting review by Hoitesh and Hoitesh, right? They're saying basically you have more tag and it reflects accounting complexity. So I have like a little time to struggling. Okay, when you have more tag, to what extent it will reflect accounting complexity? To what extent it will reflect the disaggregating quality? Like it seems a little hard to. It can be right both sides. Based on your results, it supports the disaggregation quality side. But I do find there is one finding in one table when you use the notes depth, right? And that results actually supports the complexity. Complexity, sorry, not complexity, it's complexity.
Yeah, okay.
Yes, I want to like ask what's your understanding, like how do you view right this to reconcile between this aggregation quality versus accounting complexity?
I think this is a good question. At least I think in the additional analysis we can throw both the proxies for the information disaggregation to the analysis together at the same time, because I agree in the Hoitesh and the Hoitesh accounting review paper they use the number of the tags as the proxy for the accounting complexity, but if I remember it correct, they use the number of tags on the overall the 10K filings.
Exactly,
right?
yes.
But like again in our study, again we laser focus just on the tags related to the operating profitability. And of course we can, I think we can always throw in more controls in our analysis about, for example, the other proxies about the complexities, for example, the number of the segments, the business segments reported, something like that, or at least the firm size, because size is for everything. And I believe we already control both the size and number of the reported segments. So hopefully that could make the reader feel better about the potential confounding effects about the complexities. But another thing, the really straightforward thing to do is throw both the number of tags and the average level of deaths into one regression to see, to sort of running a horse race to see which one survive. But we are a little bit hesitate to do that because these two measures have a pretty high correlation, so we may subject to the multicollinearity issues if we throw both into the regression. But at least we can give it a try. But thank you.
Thank you for your perspective.
Grian?
Right, another question. So related to that issue, I would be curious to understand the sort of interactions between what gets in the notes and what gets in the financial statements. So like if we took a case where there were like 10 things that could be disaggregated, is it the case that some companies put 3 in the statements and then the rest in the notes, and then others put, the reverse? Or is it just overall those that do more or less, and some of the allocation to one or the other is sort of random? Just more understanding about how these measures are working, I think, would be just descriptively fascinating, but then also I think would help understand a little bit more about how these, how this reporting is getting done. I think that would be useful.
Yeah, I think that is sort of related to your previous comments about some determination tests, like which firms are likely to do more disaggregation, which firms are not. So this analysis is what type of firms are more likely to do the disaggregation on the face of income statement, but there's some other firms that are more likely to do the disaggregation in the note. For now, I don't have any definitive answers, because I think these things is kind of up to the firm. It is the nature is voluntary in the nature, but maybe we can create a measure, for example, the proportion of the tax, the related tax on the face of the income statement, and run some similar analysis, or at least to show some firm characteristics. That will be helpful.
I mean, I think even just descriptively some of this, right? Because I think people have lots of sort of ideas about how firms are doing these things, but because we've been sort of limited in some of that, right? There are a bunch of studies that talk about the reporting versus sort of footnoting sort of types of stuff.
Yeah.
But now if you have the ability to get at that more completely, I think that just more descriptively that would help people. So I'm not just necessarily just thinking about your measure and maybe you capture something else, right? But just helping people understand a little more, I think, would be helpful.
Sure. Yeah, we will definitely do that. Yeah.
Are there another questions? If anyone have any questions, you can open your mic and ask your question. Thank you very much, dear Professor Daniel, for your contribution and your effort. It's really an excellent presentation, an excellent paper. Thank you very much. Thank you very much, everyone joining us today, and thank you very much, dear Professor Daniel, to take the time to present to us today. It's been really appreciated. Thank you very much.
Thank you, everyone. Thank you for all of your comments and suggestions. We will definitely try to incorporate all of them in our next draft, and all of them are very helpful for the papers, the future development. So I may shoot some follow-up email, so you can expect something from me afterwards. Thank you.
Thank you, and I hope to see you soon in Egypt. You are very welcome.
Bye.
Goodbye.